you can't fight the Fed. So in 90% of the instances, when the Fed is dovish, you have to be bullish. And when the Fed is hawkish, you have to be bearish. But 2022 and 2023 was really the exception, because in late 2022, the Fed had to be hawkish optically, but actually they had turned dovish. That's the reason we had turned bullish and stayed bullish in 2023, because even though the Fed was explicitly hawkish, they were actually dovish. But I would say those four principles govern almost 80% of how we view markets.
Got it. As a sell-side analyst, a strategist, you have to put a number out. S&P 500, 6,000 by end of the year. But the reality is that the future, as we sit here today, is a range of possible outcomes. So how do you balance that when you advise your clients?
It is very tricky to actually have what we'd call a price target, because you're picking both a level for the markets and then a time frame. And so you're trying to get two things correct. And it's especially difficult knowing that there's really never equilibrium. It's not like the stock market cashes you out at the end of 2024, but we're still trying to figure out where the market level would end up being. Most people who follow and forecast markets tend to do what you just described, which is they give you 3 or 4 scenarios, and they'll say, well, there's a 20% chance this happens, and a 40% chance this happens, and a 20% chance this happens, and so my average target is this.
Right.
I think the flaw in that is that you're now trying to assign precision and probability to 3 different events, and I don't think our clients want that because it's confusing. So we tend to stick with a single number. And the way we develop that single number is everything you've described. We look at what could the PE be, what could the earnings power be, where could the surprise come from, how much will liquidity matter, and how much would risk appetite matter. And sometimes risk appetite is the most important thing, sometimes earnings. And then we actually have to use judgment to decide which one's the most important and come up with a single number. So I would say our targets aren't science, but it's where we're the most confident that that's the most probable path. And it's a process we've been doing since 2009, actually since 2008, and it's actually worked pretty well. I know when I was at JP Morgan, for the first 6 years, we had identified the closing price for the S&P 5 of the 6 years within 1%. Now, it's not that accurate anymore, but in the beginning, the process worked well for us.
Why is it not accurate anymore?
Well, we're directionally correct most of the time. But an example is, at the start of this year, we thought the S&P could get to 5,200. But that was, in December, 15% upside. But not only was the stock market strong in December, we always established the target in early December. Not only did last year, December 2023, the market rise a lot in December, but it was strong in the first half. So 5,200 won't work as a target, as a static target, because that's a 13-month target. But it's directionally correct, because at the time, 5,200 was the most bullish view.
Got it. As you mentioned, you started out as an equity research analyst, covering telecom and tech, then bankruptcies and small cap, then became a strategist. How have you evolved? Your process, your mental models, how you think about forecasting and risk, they must have evolved over time for you. And what were the pivotal moments in that evolution?
Well, I think a lot of life lessons that I live are actually life lessons for markets.
Okay.
I went to a business school undergraduate. I went to Wharton as an undergraduate and graduated, and my first job coming out of college was at Kidder Peabody, which was a stock research firm. And I was very fortunate to have been assigned. When you get a job in research, you don't pick the sector, but I was assigned to the wireless industry, which in in the early 90s, it was in its infancy. There were only 34 million cell phones in the early 90s, and today there's 7 billion.
Right.
So you can imagine that that is a hyper-growth industry that has grown faster than even the internet. The few things I learned in wireless was, I think, pivotal to how I view markets. I mean, foremost, the wireless industry didn't generate money. The industry was always borrowing money. And so we had to develop a way to actually value the stocks, the equities, without earnings. And for most of my first, let's say, decade of that career, most people I met would say, Tom, the wireless industry is worth zero because they don't make money. But we'd always be like, well, what is the value of their subscribers or the spectrum they own, because they aren't capitalized on the balance sheet. And eventually they make money, but they have to spend marketing dollars to acquire the customers and build the networks. So it was really during that period that I learned a couple of things. One was that you can follow what the bond market is doing to know if there'll be moves in the stocks. So I learned to call our high yield desk every day and ask them the levels of different companies and were they trading better. And of course, if a bond started to trade well, then that meant that the bond market sensed something was improving, and therefore the stock would react. And so that was very helpful, and it really taught me to look at stocks as the junior piece of the capital structure. Whatever bonds are doing, stocks will follow.
Right.
Another thing I learned was how important the intangible value of an equity is, because in the wireless industry, they had to front load the cost of building the network and then acquiring a customer. So they didn't make money until 1 or 2 years later. And the wireless industry operated as what you'd call a long-term greedy business. They weren't trying to make money in the short term, but all the investment they were making created value in the future. I mean, that's today pretty widely accepted as the lifetime revenue of a customer, or we call it long-term greedy. And that's, a life lesson that you really shouldn't try to maximize how much money you make now. It's more important how much money you make over the cycle. And that's how we look at the equity markets. I think the third thing that really puzzled people was that when I was a wireless analyst, and I became pretty well known as a wireless analyst. In fact, I became institutional investor ranked only 2 years after starting coverage of the stocks, which made me, I know at Smith Barney, I was one of the youngest managing directors. I was 28 when I became a managing director there. And I was very, very fortunate to pick stocks almost at the bottom. And people always asked me, and so I had some very famous bottom calls. One was Western Wireless, which I upgraded